Okay, so let us begin. Welcome to the CA Simplified. So today we are going to start the DT revision from ICAI Saransh Material. Okay, so see, before we begin, let us understand what is tax. So taxes are considered to be the cost of living in a society. So because you are living in a society, the government is expecting certain amounts from you, okay, which the government will be utilizing for the people in general. Then taxes are levied by the governments to meet the common welfare expenditure of the society. Okay, so whatever the common expenses are there, to meet those expenses, the governments levy various taxes. Then tax is nothing but a monetary, but the money that people pay to the government, which is used to provide the public services. So whatever public services the government is providing to you, for that the government needs funds, and from where does these funds come? From the taxes that we are paying. Then we have, okay, so why does the government levy taxes? So taxes constitute a basic revenue of the government. So it is a basic source of revenue for your government. Revenue so raised is utilized for meeting the expenses of government like defense, provision of education, healthcare, infrastructure facilities like roads, dams, etc. So what the government does is they provide you with all these facilities, and for that the government is utilizing the taxes that you are paying. Then we have direct taxes and we have indirect taxes. So what is a direct tax? A direct tax is a kind of charge which is imposed directly on the taxpayer and paid directly to the government by the persons, juristic or natural on whom it is imposed. Okay. So whatever tax is there, the direct liability is on the person who is actually earning that income. And the person who pays the tax to the government cannot recover it from somebody else. Okay. So the burden of direct tax cannot be shifted. So whosoever is earning the income, that same person will only be paying the taxes. Those are your direct taxes. Then direct tax is levied directly on the income of the person. Okay. So whatever is the income of the person, directly on that only you are levying the taxes. Then a significant direct tax imposed in India is income tax. So the example of direct tax in India is your income tax. And then we have indirect taxes. So in indirect taxes what happens is that the taxpayer is not just conduit, and at every stage the tax incidence is passed on till it finally reaches the consumer who bears the burden of it. Okay, so it is a tax which is passed on to certain peoples in the chain, and finally the customer, the one who consumes the products or goods, will be doing this will be bearing this portion. Okay, will be bearing the burden of taxes. Then an indirect tax can be shifted by the taxpayer to someone else. Its incidence is borne by the consumers who ultimately consume the product or the service. Then indirect taxes are levied on consumption, expenditure, privilege or right, but not on income or property. The example, goods and good GST and your customs duty. So see, indirect taxes, what happens is that the tax burden is passed on from person to person. Okay, so it is shifted from taxpayer to someone else, and finally the customer, who is the end consumer, would be bearing the entire burden of this tax. That is the reason it is called as indirect tax. Then next we have basics of income tax. So here we have meaning of income tax. So income tax is a direct tax levied directly on the income of a person, that is your individual, HUF, association of person, body of individuals, company, firm or other business entities. Income tax is levied on the total income of a person at the income tax rates specified in the Annual Finance Act or under the Income Tax Act 1961 or both, Okay, so whatever tax rates are there, those tax rates are specified in your Income Tax Act or in your Annual Finance Act. Then, different rates of income tax are specified for distinct categories of persons under the Annual Finance Act and the Income Tax Act. So, different rates are also given in our Act. Next, we have levy of income tax. So, what happens? Our Central Board of Direct Taxes is a statutory body responsible for administering direct taxes. Okay, and it operates under the Department of Revenue in the Ministry of Finance. So our CBDT, which is operating under Ministry of Finance in the Revenue Department, they are the central body. Okay, they are responsible for administering direct taxes. Then the CBDT is responsible for formulating policies. So what are their functions? They will formulate the policies. They will formulate the policies including income tax. The levy of income tax is governed by the Income Tax Act 1961 along with the income tax rules. So you have an Income Tax Act and you have your income tax rules, and every year this act undergoes changes by Annual Finance Act. So every year in Annual Finance Act, whatever changes are there, they will be given there. Then we have components of income tax in India. So we have our Income Tax Act, we have our Annual Finance Act, then we have our income tax rules, we have circulars and notifications, and then we have case laws, which are your legal decisions of the courts. These all are your components of tax law. Now, let us start with your chapter number 1, which is your basic concepts. So, section 4 is your charging section, and income tax shall be charged for any assessment year. So, you can charge your tax for any assessment year. Now, what are the rates? Rates prescribed for that year by the Annual Finance Act. Okay. So, whatever are the prescribed rates for that particular Finance Act, by those rates you can apply the taxes in respect of the total income of the previous year. So, see, your income tax is charged for your assessment year for the income that you have earned for the previous year. And on whom is this charged? It is charged on every person specified under section 2(3). Then we have the concepts of previous year and assessment year. So what is an assessment year? It means a period of 12 months. So sorry. Okay. So what is your assessment year? See, assessment year means a period of 12 months commencing on 1st April every year, the year in which the income is earned. So, year in which your income is earned, that income is taxed in the next year. Okay. So, income is earned in your previous year and it is taxed in the assessment year and it is assessable in the assessment year. So, the year in which income is earned is the previous year, and then such income is taxable in the immediately following year, which is the assessment year. Then what is your previous year? It means the financial year immediately preceding the assessment year. In case of a business or profession newly set up or a source of income newly coming into existence during the financial year, the previous year shall be the period beginning with the date of setting up the business or profession. So, if you don't have an established business and if you are starting, in that case, whatever is the date on which you are starting that business or that assignment, okay, or that profession, that date will be considered as your previous year. Then, the date on which the source of income newly comes into existence and ending with the said financial year. So, whatever is the date on which your this business or profession is beginning, that will be considered as starting of that particular previous year and it will end on the date that financial year is ending. Okay. Then next we have general rule. So what is the general rule? So income of a previous year is assessed in the assessment year following the previous year. So generally what happens? Whatever income you have for your previous year, it will be assessed in the next year following that previous year. Now there are certain exceptions to these rules. So in certain cases the income is being assessed in the previous year itself. Now what are those cases? So in case of shipping business of a non-resident, in case of persons leaving India, in case of AOP, BOI or artificial judicial person formed for a particular event or purpose, and then you have person likely to transfer the property to avoid taxes or discontinued business. So in each of these cases your income will be assessed in previous year itself. Okay. So generally your income is assessed in assessment year, but there are certain cases wherein it will be assessed in the previous year itself. Then next we have classification of income. The income of assessee is classified into following 5 heads. So there are 5 heads of income wherein your income is classified and taxed. First one we have is salaries, then we have income from house property, then we have PGBP, we have capital gains, and we have residual head, that is your income from other sources. Okay. Excuse me. So whatever income is not getting taxed in each of these 4 heads, okay, that income will go to your residual head, which is your income from other sources. Now in salary, you have salary, you have pension, both these earned is taxable under these heads. So if you have any salary or if you have any pension, it will be taxed under your head of salaries. Then if you have any rental income from house property, it will come to income from house property. Next we have PGBP. So any income that you are deriving from carrying on any business or profession will be taxable under your PGBP head. Then if you have any capital gains, that is if you have any profit from the sale of a capital asset. Now capital assets are defined in these. So any of the profits that you are receiving from the sale of such capital assets will be taxed under your capital gains head. And now see, this is the residuary head. Okay, it's a residual head. So whatever income is chargeable to tax under the Income Tax Act, okay, so you have it chargeable under your act but not taxable under the first 4 heads. So that income is chargeable, okay, income is chargeable. Tax will be applied on this, but somehow the tax is not applied in any of these 4 heads. In that case, it will go to our last residual head, that is IFOS. Then next we have basic concepts. So we have person who is defined in your section 231. So what all things, now this is an inclusive definition, and person includes individual, HUF, company, firm, AOP, BOI, local authority and artificial judicial person. Then we have rates of taxes and surcharge and cess. So income tax is to be charged on every person at the rates prescribed. So whatever rates we are given in our Annual Finance Act or the Income Tax Act or both, at those rates the income tax will be charged on every person. Now when is surcharge taken?